All right, so that was a short section about stable coins. And now we're going to talk about decentralized money markets. And I think this is one of the key parts of the digital financial stack in DeFi. So let's take a closer look to that, right? Like, what are money markets, right? What do money markets allow us to do? It's pretty basic. Money markets allow users to lend and borrow assets. You could see this as well in the traditional markets, where you see that it is a key component for any financial market. I just typed in money markets into Google, and you can see 340,000 results in like 33 seconds on Google, with a lot of news headlines where, the money price is being put on. There is another like your purchasing power is being increased or decreased. There's higher inflation, lower inflation. Money markets provide a lot of liquidity to our current economical system that we live in today. So in our current centralized financial ecosystem, money markets play a huge role. So money markets provide liquidity for the global financial system, including for capital markets, are part of a broader system of the financial markets as of today, as of the central financial markets, right? So let's take a look at like decentralized markets. As we saw before in a previous example, in the decentralized money markets, it allows users to lend and borrow crypto assets. Lending your crypto offers a new way to earn interest on idle assets. So that means that normally if you have your crypto on an exchange, on a centralized exchange, or somewhere sticked away far in cold storage, where nobody can reach it, it's idle, it doesn't do anything. But that crypto, because it is worth value, will be better off if it's circulating in the money market. And that's why you can actually earn an interest on it, right? Unlike traditional peer-to-peer lending markets, the compound and other money markets uses a liquidity pool model, where you basically pool together different liquidities from different markets and then make a lending protocol or a lending pool, and you can earn interest into that. This is also, you can also get this in traditional markets, but in decentralized markets, it's all transparent, and you can inspect how much money is lended, how much money is borrowed. Yeah, instead of lending assets directly to users, you simply liquidate to a pool, and users borrow from that pool. Interest rates are determined based on supply and demand, right? In our compound deep dive, you will see all the different metrics of the supply of the assets and demand, and we go over all the smart contracts and all the different metrics in the deep dive. But for now, and as you already saw, you can pool assets together, and with the pooled assets, you can actually borrow or earn interest with assets that you provide to the pool. And as also shown before in the DeFi score overview, there's a whole overview of different lending protocols that you can use. It's not only Compound, it's DYDX, it's Oasis, it's much more. And it's increasing every day. So more and more pools are formed, and they're all competing to be the bigger pool, because Compound obviously also earns from the volume that goes through its protocol, same as MakerDAO. But how does that work? How does it exactly work? We saw already before, we put in like 20 DAI, and then suddenly we can borrow money. Do we have to pay it back? As you saw, we're pulling that out and putting it in. But let's go a little bit deeper into how that exactly works, right? There in blockchain, where you borrow out money, where you lend out money, when I give you money, there's no credit scores. So and blockchain are this pseudonym with no real world identity. So how can you lend money to strangers with no credit history? How do you do that, right? So the solution for that is collateralized debt positions. That means that if you need certain debt, you can actually put a little bit of assets in a CDP, collateralized debt position, also called short CDPs, and take out a little bit of value and then use that for taking margin loans, or use that for certain trading activities or other activities you want to do throughout the decentralized financial ecosystem. So how does this exactly work? When there's no credit scores on a blockchain, how can you lend out money? Well, the solution was, as discussed, collateralized debt positions. And these decentralized lending protocols, also like stable tokens or synthetics, use mechanisms called CDPs, collateralized debt positions. Similar how you may put your house as a collateral if you want to lend money for a car or another object in real life. So it functions as follows. You need to input a certain collateral. Let's say in this example we use DAI, as we also use in compounds. Then we need to have over-collateralization of 150%. If we have that over-collateralization of 150%, we can borrow a small amount from other assets, but we need to lock up that amount of value in the DeFi protocol in order to unlock that another amount of value on the other side. And we saw that perfectly working fine when we were using the compound pool protocol. Again, we will go more in depth in compound in our protocol deep dive. So, what happens if a CDP gets eliminated, right? So there's a collateralization ratio of 150%, but what happens if the collateral that's underlying goes down, right? So let's say you have 100 DAI you put in and you lend some Ether, but then that Ether value goes, the increase in that goes up too much. So you need to pay too much interest, for example. Or a better example is, let's say you use Ethereum as a banking collateral, right? Then the total collateral required is falling to meet its requirements if, for example, the price of Ether goes down compared to the other assets. So you need to really monitor that. So it comes down to basically if the market value of the collateral is the same or smaller than the collateralization ratio of 150%, then the loan is under collateralized or in liquidation. So that means that in a blockchain protocol, when there's like bots, similar to happens in Compound, scanning the blockchain, if there's any under-collateralized positions, if there's an under-collateralized position, then basically that position will be eliminated and there will be a small penalty that needs to be paid. So when your position gets eliminated, let's say you put in 100 DAI or 1 Ether, whatever, then when your position gets eliminated, depending on the liquidation penalty, you will get back maybe 90 DAI or 80 DAI or 95 DAI. It depends all on the metrics and on how severe you are suddenly under collateralized. So this is the basic mechanism of a CDP, or collateralized debt position. When we go more in depth into our MakerDAO deep dive, we will start to open up a CDP position on the Oasis stack, as you can see here, where a certain amount of there's a liquidation price, there is a collateralization ratio, and you can see how much DAI is outstanding, and you can see how much DAI you still have available to generate out of your locked Ethereum that you locked at that moment, right? So for example, here, there's an amount of Ethereum that's locked. In this case, it's 3 Ether. You can withdraw a certain amount of Ethereum here. And the outstanding DAI is just 3 DAI, which is not that much. And there's still 4,000 DAI available to be generated. And these metrics change all the time. We will do one of these the vaults ourselves in the MakerDAO protocol deep dive. And once again, decentralized money markets are one of the biggest factors in your decentralized financial stack. So it's important to do also a deep dive yourself, do some research, see if there's other decentralized money markets that are now being created on other chains. And look, for example, maybe at EOS or RSK or Tezos or other money markets that are now being created. And leave your comments on the Toshi Times forum, and we can start chatting there over potential new decentralized money markets that are created, or how we can improve the decentralized money market on Ethereum. Thank you.